Thank you. Hi, good morning, good afternoon, everyone. This is Usha Nandigala. I'm the host of the Infinity Forum Club. So today we are doing a podcast about investments, all about smart investments. Let's do a deep dive on investments. And with me, I have Ashish Shah from Cyan Capital. So happy to have him on this podcast. Ashish and I've been talking for about last 6 to 8 months, and we're looking at having a strategy. He's helping out my family investments. And Ashish, I'm impressed with Cyan Capital, and Ashish comes with a incredible background, about 17 to 18 years in financial advisor, wealth management, portfolio management background. He's from Berkeley, went to Berkeley and Marshall School of Business. So I will let Ashish introduce himself first and also introduce Cyan Capital. The background of the founder is very was interesting. After the introductions, we'll start off with the general deep dive questions around investments, and I think we all will enjoy the podcast thoroughly. Thank you, Ashish. Why don't you get
Thank,
started with your introduction?
sure. Thank you, Usha, and thanks for having me. I'm excited and delighted to be here this morning. So I'll give you a little background about myself, which Usha highlighted. I spent most of my career in finance. Started my career in equity research for an investment bank, and then after that, I did work in the technology industry for a few years during the dot-com boom in the Bay Area. And as you should know, prior to that, I was at UC Berkeley, where I did a double major in economics and environmental science. Um, Post my experience in technology, I moved to LA for my graduate school. So I did USC's Marshall School of Business. And upon graduation, I worked in the investment management space, particularly where I was running fixed income assets, high yield, leverage loans, private credit, investment grade, so all different types of fixed income securities. Did that for many years, and then transitioned from that into the wealth management side, where I am today with Cyan Capital, where we work with a number of affluent investors and families. Um, we a little bit of the genesis of Cyan Capital. Cyan Capital was started by Ashu Chopra. He had spent most of his career working for the big brokerage firms, Goldman Sachs and Merrill Lynch. And a few years ago, after being one of the most successful advisors at Merrill Lynch, decided to leave and start his own family office. Um, and the reason why he left was that because of the sort of restrictions that those brokerage firms were placing on him in terms of investments and things that he wanted to do. So he left and was just going to run his own family office. But in turn, what happened was many of the clients that he was working with decided to join with him. They said, hey, if you're going to do it for yourself, why not do it for us? And so what happened organically was that a firm was formed. And so suddenly all of these clients came on board. And so rather than just kind of do one off, he institutionalized our offering. He has a passion for this, so it's not a chore for him by any means. And with that, the firm has grown. Today, we manage just about $4 billion of assets across, like I said, ultra high net worth clients. We have three major pillars: the investment platform, estate planning, and tax planning. We use all three of those sort of pillars when we're advising clients on how to manage their wealth. And then surrounding that area, those three pillars are things like charitable contributions, administrative services like bill pay and bookkeeping, legacy planning. And so it's a whole full suite of services that we provide our clients, and it's a very white glove approach when we're speaking with them.
Thank you, Ashish. And I remember you telling me a lot of Silicon Valley founders and startups have been
Yes.
your customers or clients, and you've seen their wealth grow, whether in startups or while you guys managing it. So, and my son is there in Silicon Valley now, and we are hoping to see that he will get some help from your organization as well.
Yes.
So,
That's a good point, Usha. Yeah, many of our clients, being Bay Area based, come from the tech ecosystem. So we do
Mhm,
work with a lot of founders, tech executives,
mhm,
venture capitalists, angels, all clients of ours. It doesn't mean
mhm.
they're exclusive to that. Well, it just happens to be, close proximity, and that's where, of course, a lot of wealth is being generated. But we have clients that have made their wealth from all different disciplines, small
Mhm.
businesses, real estate, and some are just inheritance. So
Yeah,
we don't judge where the money comes from. We just help to preserve it and grow it.
absolutely. So now let's get into what we call smart investing, right? The last 10 years, how investing has been, it's not going to be the same next 10 years. Everything in world is changing so fast. The innovation cycles are shorter, so many startups, and the macroeconomics and global impact. I think money is moving instantaneously due to all the volatility. So with that, in this era, with that said, in this era, what do you define from your point of view? What is smart investments? What is a smart way of investing?
Smart investing is still, in my opinion, it's still tried and true. It's always been. It's due diligence. It is a core component that often gets lost when people start making investments. Really understanding what the investment risks are, what the growth projections are, and really take a deep dive. Is this the right investment for me? The due diligence has never really changed. What has changed is what we're just doing the due diligence on, right? If we
Mhm.
talked about digital assets, cryptocurrencies, this is something that didn't exist 20 years ago, but now we need to understand it. So what are really the dynamics around that? It's not enough just to follow the trends, things you may see on CNBC or read on Reddit, or other blog posts. You really have to understand it for yourself. So it does require that deeper dive, and through that, self-education, right? Not everyone has the same level of understanding of all these different types of investments. So hence the due diligence is critical in that. And then the second thing I think smart investing is really understanding yourself. I think oftentimes people are not really true to who they are in terms of their risk tolerance and their investment objectives, right? When I often come across people when they're making investments, it's like, well, I just want to make money. But really, is it within the parameters you're trying to do it? Do you really have the stomach for some of the volatility that may occur? Do you have the ability to withstand illiquid scenarios? Um,
Mhm.
and what is the goal of making this wealth? So all of those things I think are very important when it comes to smart investing. Really understanding yourself and doing the due diligence. And with that, it does help to sort of narrow the scope and make it a little bit more manageable as you kind of look at the investment landscape.
Do you want to call out any misconceptions about how traditionally smart investments have been done? Anything has changed? Because a lot of my club members have been more of a traditional investors in their 50s. So are there any misconceptions you want to call out?
There are misconceptions across a lot of different landscapes. I think there's this idea that some people, it does work for some people, but for most who are creating more wealth, it is more complicated than what it seems. So the traditional investing of just having a 60-40 portfolio of stocks versus bonds
Mhm.
doesn't just apply, right? We need to have a
Mhm.
diversified portfolio. We've talked about diversification,
Yeah.
it's been talked about ad nauseum for decades. But what does that really
Mhm.
mean? It's diversifying within each sub asset class. So it's not
Mhm.
just having public markets, it's having private market investments and having uncorrelated assets. So when one goes up, it doesn't mean they all go up. One may go down. And so you're offsetting each other. So at no one time is everything moving in one direction. And
Mhm.
that used to be the case when you had a 60-40 portfolio where if the
Mhm.
equity markets went up, the fixed income markets might be a little bit flat to down and
Right.
vice versa. However, what's happened is that we've seen this in time and time again particularly over the last decade, where you've had a correlation of one, where they've both gone up and they've both gone down. And
Right.
so how do you sort of invest against that landscape? Well, it's adding things like private investments, private equity,
Mhm.
private credit,
Yeah.
real assets, venture capital, digital assets. And there's even a lot of other nuanced things like sports and music, and and the list goes
Mhm.
on and on. It's not for
Yeah.
everyone, but the point is having a very true diversified portfolio.
Yeah. And not everybody has access to the diversified portfolio you talked about, right? That's why coming to somebody like you gives that access to that more diversified portfolio you talked about.
That's
So we'll
correct.
get it. Yeah. We'll get into the details. And that's one of the reason I'm working with you too, for more of a diversification of my portfolio. So let's go a little deeper into the strategy. You mentioned all the alternate investments, digital assets. There's also a lot of debate going on of active investment and passive investment. So if somebody comes to you with 10 million, I remember you telling me average check size or client is about 10 million. They want to preserve their wealth and they also want to grow their wealth, of course. What kind of portfolio, what kind of strategy would you suggest? What kind of asset allocation would you suggest?
Right. So I will answer that in two ways. So one, there's a lot of parameters, right? Not each $10 million check is equal, right? People have different ages and investment directives and risk tolerance. So it's just not a sort of, it's not a catch-all for everyone. And with that too, there's a lot of trust that can be developed to help shield those investments. So it's kind of twofold in that when you're making investments, but you also want to be very tax efficient in those investments, right? So, and you utilize trust in different vehicles to optimize those investments. Having said that, a $10 million portfolio on average, where we kind of place it, we generally allocate between 20 to 30% of the portfolio in alternative investments. I think we talked about private equity, private credit, real assets, and 60% or so in public markets. We use an asset allocation model where we use about 35 or so ETFs. So they're all sort of passive ETFs, right? ETFs are passive investments across equities and fixed income. But within those, there's a lot of overweights and underweights. So based on geography, sectors, and there'll be a little bit shifting within there. So currently, depending on your risk tolerance, it could be anywhere from 70% equities to 30% fixed income, or 80-20 to the other side of it, where maybe it's only 40% equities and 60% fixed income. So it really depends where you are on the public side. And there's a lot of movement within there too of how you make those overweights between each of those categories based on economic factors and basically based on economic factors where we stand today.
So the fixed incomes, what are initially fixed incomes were little bonds and money market, and what is fixed income nowadays? What do you categorize in fixed income?
Fixed income, I mean, in general, yeah, it still is the bond universe, but within fixed income, there are many, many different sub asset classes, and they're all extremely large. So there's corporate bonds, right? What we call investment grade. These are high quality bonds. These are bonds that are rated BBB and above by Moody's and S&P. Below that, there's high yield, a little bit more risky than bonds. However, even though they're high yielding assets, they are still have less risk than owning an equity. Then there's municipal bonds, right, which are often used for tax advantage strategies, lower risk. There's treasuries, Ginnie Maes, Fannie Maes, all government agency securities, very high quality, lower yield. The basic way to think about it is the lower the yield, typically the lower the risk, and the higher the yield, the more risk. But again, within that, you want to be balanced as to what are you looking to get out of the fixed income portfolio? Are you just trying to generate income for lifestyle, or are you trying to just use it as a means to preserve cash against some of the higher volatility investments you may have?
Well, how do you categorize the golds and silver ETFs, and would that be still under ETFs, or you could put it at fixed income?
We use that. So we use that within our portfolio. So we do have exposure to commodities. So we use gold and other commodity ETFs in there. And that's anywhere that ranges anywhere from a 2 to a 4% allocation within our strategies. Again, it fluctuates. And recently, and I want to say recently, it's been about a year now, we started including a 1% slice into digital assets. We do think digital assets have a place in the portfolio, but we think it's, as where we sit, in our opinion, that's still very small. And when I say digital assets, I'm just referring to like things like Bitcoin, so actually the coins. There's another component, which is blockchain area, which is a different element and animal, but within that Bitcoin area, we're using ETFs.
So anything else on the strategy? For example, we talked about my son having the money they raised for startups, right? Keeping them liquid at the same time, beating the inflation of that money.
Mhm.
What certain assets like that. What's also your opinion on annuities and insurances? I think I'm putting too many questions in. Uh, I think and also about something I just uh, annuities, and what are the hedging mechanisms you would use apart from the portfolio diversification?
Sure. So there's a couple of things there. On when it comes to sort of what we call cash management or liquidity management, the traditional way, right, has always been just kind of putting it in a savings account or maybe a money market fund. Money market funds have been great for the last several years because of high interest rates, right? We were flipping north of 5% of the money market. That has come
Mhm.
down now quite a bit with interest rate cuts. They move very closely as interest rates get cut, so do your money market rates. Where we sit today, they are just under 4%, about 3.8% right now. And as we continue to get more cuts, those money market rates will continue to
Go
come
down.
down. So how do you then sort of maintain that yield advantage, particularly when we're in an inflationary environment, like this 2.5%, 3% inflationary environment that has been stubbornly there and may increase with tariffs. So we use a different strategy where we add in multiple other sort of very low risk investment vehicles. So what I mean by that, we'll use short duration corporate bond ETFs. We'll use what are called structured products. Um,
Mm.
these are basically structured investment vehicles that are ladders with loans, leverage loans within there. You're buying
Mhm.
different tranches within there. We stick to the highest tranche. These are like plays where you get a little more outsized yield without taking on necessarily significantly more risk. And you
Mm.
combine that with treasuries, money markets, and other things of that sort. So again, a slew of different investment vehicles to get a yield advantage relative to just staying in money market funds. When it comes to annuities, we have
Mhm.
not been big adopters of annuities
Mhm.
at our firm. So really, we don't use them. We don't recommend them.
Mhm.
And so I don't want to. There is a place for it, and I'm sure in some people's portfolios, but for our clients and their needs, we think there are better alternatives that are out there that are better um, in terms of not just uh, generating the returns, but having more
Mhm.
liquidity and at a lower cost. Annuities can be quite expensive. And
Mhm.
so we feel like, and it can be restrictive. So we feel like we can get better returns, have higher liquidity for a cheaper fee rate using traditional fixed income instruments for those that want, uh, income.
Okay. How about life insurances? Do you guys are a big proponent of for taking care of the tax advantage life insurances?
Yeah, so we're not insurance provider, but we do partner with
Mhm.
insurance folks. So there are places for that in the portfolio. Certainly, life insurance. Uh,
Mhm.
there's private placement life insurance for those that meet the higher income thresholds that we're starting to use. They're called PPLI. These are basically insurance wrappers where it allows investors to have full reign of investments within this insurance wrapper so they can really grow their
Mhm.
investment and be tax
Mhm.
advantaged with that. So we
Mhm.
certainly do uh, recommend and advise, but we partner that. We are not experts in the insurance, but we do work with either the client's insurance folks or we have our referral network that we use within there. So it's certainly a place and used within the portfolio.
The irrevocable trust with life insurances, you customers do that, or is it an older traditional mechanism?
No, it's not. I mean, we have clients, right, younger founders who are maybe in their 30s and 40s, where
Mhm.
you start to think about certainly using life insurance. Some use, some don't. It really depends on the size of the estate. But
Mhm.
we certainly use various different types of trusts within there. So depending on the client situation and their holdings, yes, we use all different types of trusts. Generation skipping trust and charitable contribution trust, and there's a whole slew of it. Within our firm, we have a former in-house estate attorney. She's now called an estate specialist. Since we're not a law firm, she can't actually practice law. And she helps all of our clients really strategize on what
Mhm.
are the types of trusts you should be using and where they should be created whether it's Delaware, Nevada, depending on your home state,
Mhm.
and different and what assets should be placed in those trusts. So this is someone that has the deeper expertise in that to
Gotcha.
help manage the wealth, but also look at it from viewing that lens through taxes, right? How can we minimize taxes? So putting different parts of your assets in those trusts to deflect, whether it's for you, for your
Mhm.
kids, your heirs, or charitable, wherever the client wishes to have that money moved on.
Okay, I think one last question in the investment strategies. The private equities and VC markets, there's so much, they've grown so much. It's become hard to keep track of. So I know you've suggested few funds through your company to me. So can you do a little deep dive on how do you keep track of the private equities and VCs? And there's so many of them, and IPOs are not happening as often. So it's a lot of money going pre-IPO. So
Mm-hmm.
can you do a little bit of insights on that?
Sure. Yeah. So what we talked about earlier, using private equity, it's one is having access to those opportunities, but understanding within, as I've talked about before, with even private equity, we kind of use that as a catch-all phrase. But within there's a lot of sort of sub-investments, subcategories, I should say. So as you noted, Usha, traditional private equity, if you think about it, if you're not familiar, is when a private equity firm will buy a company that is trading publicly and maybe is undervalued or being mismanaged. So a private equity firm will come, buy all those shares, take that company private, retool the company, sell underperforming divisions, invest money here, change management, do whatever they need to do. And over a 7 to 10 year period, turn around this company, really grow it, and then sell it. That's the most traditional sense. That's what we call a leverage buyout, LBOs.
Right, right.
What's happened, that's your traditional private equity. But what's been happening over the last decade, as you noted, because there's been a lack of liquidity in the market, meaning the IPO market's been very dormant. The M&A market has been also very dormant for the last several years. So a
Mhm.
lot of these companies that were thought to go public or to be sold are no longer happening. So it's created, which has always been there, but it's actually flourished, other areas in private equity, things we call continuation funds,
Mhm.
secondaries. These
Mhm.
are funds that go in and buy the interest of other LPs. So as an example, if a large pension fund that is invested in a private equity fund, they need that, they've timed it out with after 8 years, they need that capital return so they can make new investments and or pay their employees who are on
Mhm.
pension. Sorry, the retirees. However, there's no market. The fund is still performing. They can't sell it because there's been no liquidity events. So secondary funds will come in and buy that interest from
Mhm.
this institution. The
Mhm.
benefit of that as the buyer is that because there's no liquidity in the marketplace for this, they can buy this at a deep discount.
Mhm.
So inherently, you're buying this investment at a deep discount and you're buying an investment that is now mature. You're not buying it from day one where you have to turn around the company. You can look at this company today in those portfolios and say they've held this company
Mhm.
for 8 years. It's already worth a lot. They just can't
Yeah,
monetize it yet because the capital markets are not allowing them to.
yeah.
So not to get too far into the weeds, but that's just something that we look at. So when you talk about private equity, there's a lot more nuance within there. So we work with a lot of those types of managers, a lot of the household names they might be familiar with. You might have read about Apollo, Carlyle, Ares, KKR.
Mhm.
A lot of these types of managers we use their funds. Same thing on the
Okay.
venture side. There are a lot of venture capital firms, and there seems to be more growing every day. It requires, again, going back to the smart investing comment, a lot of due diligence. So, we really talk to all of these managers after we screen them, understand their investment process, philosophy, what's their secret sauce, why do we think they're going to win. And once we select our managers, we let them do their thing. We don't try to interfere, telling them this technology or this sector, right? We're betting on the people that we've hired the
Mhm.
smartest fund, the smartest people, and let them go do what they do best, which is go find the next great unicorn or decacorn.
Yeah,
And so it does
perfect.
require a lot of due diligence and sort of monitoring. So it's constant communication with all of our investment partners.
Perfect. We're scratching the surface of many, many topics. I think we covered at a high level the strategy, portfolio strategy, and investment strategies, and how to be smart about it. I think next I would want to get into, we kind of covered this a little bit, family wealth and legacy and structures. You did mention about the trusts, different trusts, and also we talked about, we can talk about the LLCs, FLPs. So what kind of structures at a high level, similar to our previous topic, introduce my club members to how to create legacy with your wealth, with forming around different structures or LLPs. So if we can do a little deep dive into that.
Yeah, so there, I mean, there's a lot that's involved when you're creating that legacy planning. So again, it goes back to creating those various types of trusts. So right, most clients, if they have anything, they just have that standard living trust, right, which is great to put your assets in.
Right.
But depending on your wealth and depending, the estate taxes now is $30 million for a couple in terms of the estate taxes. So anyone above that threshold, now you've got this really large estate tax issue. And when you factor in the estate tax, capital gains tax, sales tax, you capture all these taxes. It could be anywhere 70, 80% taxes you ultimately be paying. It's really incredible. We've done the math. And so how do you now protect against that? Well, there's a lot of different ways, right? One, on the trust side, setting up various entities. And LLCs is one thing, but it's really about the trust and where those trusts sit, whether they're in what state and what assets are being put in those trusts. So you want to take those assets out of your estate and put it into different vehicles to reduce that sort of estate tax burden. When done properly, you may not necessarily avoid all the estate taxes, but you can certainly defer it, which is still a very powerful tool because now you have assets that are growing, tax deferred, just as you think as your IRA can do, and then you'll pay it down the road. But maybe you can adjust cost basis will be changed. So there's various types of trusts that we can talk about. I'm not the expert in all of those trusts. That's when we talk to our estate attorney who can really do the deep dive in those vehicles. But we do use a lot of those things. And then within there, we talk about insurance, right? Using those insurance wrappers so that there is a tax consequence that may come. You have a life insurance policy that will basically use to pay any sort of state taxes. So what we try to do is when we're talking to our clients is that it's one thing to shield these taxes as the current investor, right? The let's call it the parents, if you will. But how do you also shield it from your kids? Because you don't want to leave them the burden if they have to be forced to liquidate assets to pay for these taxes. So we'll set up in such a way that they're not burdened with of having to pay a huge amount of taxes because they may not have the ability to do so. So that just goes with a lot of that creating that roadmap of what makes most sense and where do you want those assets. Irrevocable trust, right, is another area to take those assets out. If you know you don't need those dollars, take them out, put them in an irrevocable trust, and leave that for your kids. And now that won't be taxed. So there's a lot of different avenues that you can use that to take assets out that you can still use it for yourself, but you can shield it from taxes. And then the last thing I'll say, and I've been going off a little bit, tax loss harvesting strategies. These are other investment strategies that we use across all of our investments. We'll pretty aggressively use these. These are investments that generate tax losses while still generating a return. So if you think like I'm going to get an S&P 500 return, somewhere close to that return on an annual basis, but I'll also generate tax losses, and I can use those tax losses to offset my current income, W-2, other capital gains. I can carry it forward to use that for future potential taxes. So we're pretty aggressive users of tax loss harvesting strategies as well.
Good. I think we scratched the surface there too. The next topic, I think equally powerful and important, is investor psychology. So many of us in my forum, we are self-investors, and we've grown the wealth to some extent, but emotions are a big part of our investments. So let's talk a little bit about however disciplined you want to be. When we see the volatility and markets dropping, and the April 9th or April 8th, the event when tariffs came out, it was like for the whole week, it was down. And however disciplined you are or however experienced you are, so it's hard to control the emotions and sentiments. So what are your philosophies around that? Do you just close the laptop, don't look at the markets?
I mean, unfortunately, I can't. I do have to look at it because we get clients that call who sometimes
Yeah.
panic when we have, as you noted, like during Liberation Day,
Yeah.
when all the tariffs came out and the markets really
Yeah.
tanked. We've been doing this for a long time. We've seen a lot of cycles, and I'm sure all of those, even though, and all of you and those in your club have seen different cycles, though maybe not involved day to day, but you've
Mhm.
experienced them, right? We saw markets downturn in 2022, during COVID period. We saw it short dips 2015, of course,
Mhm.
2008 financial crisis. We saw in 2001 the dot-com bust, right? These are extreme markets, but we've also seen what people forget that the markets rally. So having that
Yeah.
long-term approach, you have to be able to ride out the storms. And it goes
Mhm.
back to what we talked at the top of the hour, knowing yourself. That's smart
Mhm.
investing. Really taking the time to understand, do I really have the stomach for these types of investments? If I'm going to be
Mhm.
betting on a few handful of stocks, do I have the stomach that if this goes down, I'm going to ride this ship, right? Knowing,
Yeah.
being able to ride through it, but then also being disciplined and knowing when to sell, never having that emotional attachment. Well, I bought
Yeah.
this stock when 20 years ago, and it's a part of me. I never want to sell it. Well, the stock doesn't care, right? You just have
Yeah.
that emotion to it. So you have to detach it. This is just an
Yeah.
investment. You cut your ties and you move forward. So really understanding that what is lost, what we often see, particular environments like this. We've been in a bull market for many, many years outside of 2022 blip.
Mhm.
It's a rising tide lift all ships scenario, right? Maybe you're just putting money into the market. Everyone owns Nvidia and Google and Meta and all the same
Yeah.
names. Everyone's happy, but everyone's in the
Mhm.
same boat. And so what happens when things go south? Everyone's gonna be selling those things because everyone owns them. And so everyone right now thinks, well, I can do this on my own because I'm making great returns. And everyone is. It's fantastic. But
Mhm.
it's during those volatile times, like, well, how do you react? What do you do to
Right.
protect yourself? How are you managing investment? And that goes back to the
Right.
diversified portfolio. And so
Yeah.
having being disciplined, understanding yourself is one way to help sort of remove that emotional barrier. We all have emotions. I mean, myself
Mhm.
too. But if you have to stay disciplined through this process, and if history is any guide, you always kind of come out the other side. If you sold in 2008 and never got back into the market, you missed out on the greatest bull run of
Mhm.
2009, 2010, and 11, which were
Right.
phenomenal
Right.
years. And you've
Right.
more than made up those losses of 2008. And we've seen that again, 2015, 2022, markets were down
Right.
22%. 23 and 24, they were up north of 20%, um,
Mhm.
as well. So again, you've made up those losses already for those years. So
Mhm.
staying true uh, to those,
Mhm.
staying true to yourself as well as having that long-term investment horizon is important.
Yeah. Yeah. Totally agree. Easy said than done.
That is for sure. Yes,
It's
it's always when you look at day to day, it's not great. Sometimes we do tell clients, hey, just don't look at the market. Don't worry about it.
okay, I know.
Your
That's
investments
what
are
I try to
fine.
do.
And I guarantee you a month from now or 3 months from now or 6 months from now, however that time period is, you'll look back and
Yeah.
like, oh yeah, my portfolio is doing well. And all those day to day volatile movements, you'll
Yeah.
have sort of skipped and solved yourself the heartache.
Yeah. Yeah. So, Ashish, I appreciate all the insights, and it was fantastic topics of discussion we had so far. I think another general question I want you to ask before we close the podcast is there's so many metrics people look at for their portfolio, how they're doing, and so much noise around there. So, what are your key indicators to test or to assess your portfolio or strategy? Any key indicators you have, or any golden rule of investing you have, you can share with us. Anything of that sort before we close. Anything you want to add, and then we can we can close the podcast. Yeah.
Sure. I don't think there's necessarily a golden rule, but it's understanding when you're making an investment, what is that investment return expected to do? And then
Mhm.
how am I doing against around that?
Mhm.
Right. So if you're investing in, say, a private equity fund, and you anticipate based on the research and based on their past performance that it's going to generate anywhere from 18 to 22% return over a 7-year period, let's call it.
Mhm.
How are you tracking against that? right? And so
Yeah.
it's something's like, am I beating it? Am I below that? Am I matching it? And I think that's important to understand. Just understand what is that portfolio metric doing, and then you look that against that investment. How is it doing against the benchmark? So if I'm invested in one private equity fund, well, how is the private equity industry doing as a whole? Am I against that or below that? You have to
Mhm.
measure these investments against the proper index. I think too often times we see people saying, well, why do I want to invest? You only made me 7% and the market's up 12%. Well, you're at a diversified portfolio. You have to look at each component. Well, how did the equity portion of the portfolio do? So that's
Right.
very important. And I would say if I'm going to look at any one number, if you put force me to say one thing, is what is that risk adjusted return? What's that Sharpe ratio? What am I taking on undue risk to get that return, or am I not? So if I can get 10% and the markets are 10%, but I have a diversified portfolio, I've done a great job because on a risk adjusted basis, I've really beat it. If I bought one stock and I got 10% return and the S&P 500 10% return, I've actually done on a risk adjusted basis poor because I've taken a
Right.
lot of risk by putting all my eggs in one basket.
Mhm.
So that's very important. So that would be if I had to pick one, I'd look in that risk adjustment metric. But there's a lot of factors
Wonderful.
that go into it. It's difficult to simplify all of those things in sort of a very
Mhm. Mhm.
sort of one pager, if you will, capture. So
Yeah.
there's a lot that goes into it, and a lot of topics
Yeah.
we didn't even touch on, like economic factors, right? A lot of economic factors that go into how you're
Mhm.
positioning the portfolios, and how you adjust those portfolios over time.
Mhm. Mhm. I forgot to ask about the international markets. Are you guys going into more international markets now? Like even
Yeah,
India, Japan? Um,
we have exposure to those markets through those ETFs, and we have been increasing them. It moves around, right? We had been reducing our China exposure for the last year and a half almost,
mhm.
and that's
Mhm.
that's going to be well.
Mhm.
And we have been starting to increase exposure to markets like uh, India, and other sort of
Mhm.
emerging markets. So we always
Mhm.
have that component, and now we shift the weighting. We do see the international markets as right now having stronger legs, if
Mhm.
you will, stronger tailwinds.
Mhm.
Europe, India, now they've got
Yeah.
other issues as well, but just given how the U.S. and the current
Mhm.
administration is becoming a little bit more uh, centered around themselves as opposed to, being America first versus being a
Yeah.
more of a global player, it
Yeah.
is causing other countries to
Mhm.
reinvest more aggressively into their home country. So there are some other tailwinds that
Right.
should emerge from those emerging markets and international markets.
Yeah. Yeah. It's good to see all those trends, what is happening, the change in policies in every country, looking at the trends and predicting
Mm-hmm.
where the money should be is definitely a strat. You should have a long sight.
Have a
You
long
should,
sight, yeah. Like defense, like
yes.
aerospace and defense is probably the most obvious one, right? We've
Yeah.
seen
Yeah.
it's happening.
Hmm.
Our government been forcing other NATO members to increase their defense spending.
Hmm.
It's happened in Israel and the Middle East. They've been increasing their defense spending. Cybersecurity is becoming a much bigger thing.
Right.
So if you look at all that investments, okay, we should have strong exposure there. All that
Yeah.
money is going to create and really flourish that segment. We think over the long
Absolutely.
term. So how do you
Yeah.
get that exposure to that, as an example?
So Ashish, I think we covered a lot of topics. Is there anything else in investments you think I didn't ask we should talk about a little bit? I'll let you. If
Uh,
not,
we covered a lot, and I'm sure I can be here for all day talking about this stuff. I do enjoy it. There's a lot of things that go on in this
all
space,
right.
and there's a lot of different
So
asset classes. But
yeah, I
I
know.
think we
I
should
know.
stop there because we don't want to. I don't want to get
Yeah,
too
yeah.
deep into the weeds.
Yeah, it shouldn't be a monotonous conversation to let me have my forum people listen to this insightful conversation we had. It was very insightful. We covered the breadth and a little bit of depth. I think the breadth gives them more topics for them to research even and come
Hmm.
back with more questions. And I'm sure people will take some action items, insights back, do some homework, and come back to me or come back to you. Ashish, I will
Great.
share your contact with the team members. At Infinity Forum, we're always about, we call it limitless learning and limitless impact. So we are continuously learning. Once every 2 months, we get together and we are continuously investing, creating an impact in the society. So with that said, I thank you so much. Appreciate your time and your organization. I will stay in touch. Thank you so much, Ashish. Thank you.
All right. Thank you, Usha. Appreciate it.
Bye.
Bye-bye.